Hello, my name is Reza and I would like to present chapter 14 of Dominic Salvatore's book. This chapter is about long-run investment decisions in capital budgeting. The beginning of this chapter is talking about overview in capital budgeting process, and then it examines the various steps involved in capital budgeting and the key roles that is the marketing, production, and financing department play in the process. First, of course, we have to know what is capital budgeting. It is a process to plan expenditure that give rise to revenue or return over a number of years. Capital budgeting is not only used in planning to replace one-off equipment or expansion of production facilities or entering a new line of product entirely, but also in planning of major advertising campaign, employee training, research and development, the decisions to buy or rent production facilities or equipment, and any other investment project that would result in cost and revenue over a number of years. In general, firms classify investment projects as following categories: for replacement, for cost reduction, output expansion of traditional products and market, expansions into new product and market, and government regulation. Capital budgeting is essentially an application of general principle that a firm should produce the output or undertake an activity until its marginal revenue of the output or activity equal to its marginal cost. In capital budgeting framework, this principle implies that a firm should undertake additional investment projects until its marginal revenue from the investment is equal to its marginal cost. The schedule of various investment projects open to the firm should be arranged from the highest to the lowest returns. This represents the firm's demand for capital. In the capital budgeting frameworks, this principle implies that a firm should undertake additional investment projects until its marginal revenue is equal to its marginal cost. The schedule of various investment projects open to the firms, arranged from the highest to the lowest returns, is representing the firm's demand for capital. The marginal cost of capital schedule, on the other hand, gives the cost that the firm faces in obtaining additional amounts of capital for investment purposes. The intersections of the demand and marginal curves for capital that the firm faces determines how much the firm will invest. This is shown in the next slide. The various letter bars indicate the amount of capital required for each investment project and the rate of return on the investment. The top of each bar thus represents the firm's demand for capital. The marginal cost of capital curves show the rising cost of raising the capital amount of capital that the firm faces. The firm will undertake project A, B, and C because the expected rate of return on this project exceeds the cost of raising the capital to make this investment. On the other hand, the firm will not undertake project D and E because the expected rates of returns are lower than their capital cost. One of the most and difficult aspects of capital budgeting is the estimation of net cash flow from a project. This is the difference between cash received and cash expenditure over the life of a project. Since cash received and expenditure occur in the future, a great deal of uncertainty is inevitably involved in their estimation. Some general guidelines must be followed in estimating cash flow. First, cash flow should be measured on an incremental basis. Second, cash flow must be estimated on after-tax basis using the firm's marginal tax rate. The third, as a non-cash expense, depreciation affects the firm cash flow only through its effects on tax. This is the example of calculation net cash flow of a project. With the initial investment of $1 million, in the first year, sales could generate revenue about $1 million. To calculate the net cash flow is to add the net profit with the depreciation. The question is now is whether the firm should undertake the investment. One method of deciding whether or not a firm should accept an investment project is to determine the net present value of the project. The NPV of a project is equal to the present value of expected stream of net cash flow from the project, discounted at the firm's cost of capital, minus the initial cost of the project as pointed out in the equation. Another method of determining whether a firm should accept an investment project is to calculate the internal rate of return on the project. The IRR on a project is a discount rate that equates the present value of net cash flows from the project to the initial cost of the project, as can be seen from the equation. In case of capital rationing, the firm should rank their projects according to their profitability index and choose the projects with the highest profitability index rather than those with the highest NPVs. The profitability index of a project is the discounted value of the cash flow divided by the initial investment of a project as seen in the equation. Another essential element in the capital budgeting process is how the firm raises the capital to invest. They can raise the funds internally, which creates certain opportunity costs if the funds were to use outside the firms. Or the firm could use external source of funds with the lowest rate of return that lenders require to lend their money as the cost of these external funds. This is what we call the cost of capital. The cost of external financing, or the return that the lenders require to lend their funds to the firm, is what we call the cost of debt. The estimation of cost of debt is pretty straightforward. The after-tax cost of borrowed funds are the interest rate multiplied by 1 minus the firm marginal tax rate, as you can see the equation on the screen. The cost of raising funds internally, or the opportunity cost of the firm funds, is what we call the cost of equity. There are at least 3 methods to determine the cost of equity: the risk-free rate plus the risk premium, the dividend valuation model, the capital asset pricing model. The risk-free rate is usually taken out from the 6 monthly US Treasury bill rates. The reason for this are the obligation to make the payments of interest and principal on the government securities is assumed to occur with certainty. The risk premium is composed of 2 components. The first is components result. Because of the greater risk involved in investing the firm's securities as opposed to investing in federal securities, the second component is resulting from additional risk resulting from purchasing the common stock rather than the bonds of the firm. First, I like to point out that with perfect information, the value of a share common stock of a firm should be equal to the present value of all future dividend. To evaluate the dividend, we use several dividend models such as zero dividend model, constant growth model, and variable growth model. Another method commonly used to estimate the cost of equity is the capital asset pricing model. This model takes into consideration not only the risk differential between common stocks and the government securities, but also looks the differential between the common stock of the firm and the average common stocks of all firms on the broad-based market portfolio, or as we call it, the systematic risk. The capital asset pricing model follows the same principle as risk-free rate plus risk premiums, with government T-bill rate as risk-free rate and the systematic risk or beta coefficient, multiplied by average rate of return on all shares of common stock minus risk-free rates as the risk premiums. The equation is as you can see on the screen. In general, firm is likely to raise funds from undistributed profits by borrowing and by the sales of stocks. Since the interest paid on borrowed funds is tax deductible, while the dividends paid on stocks are not, the cost of debt is generally less than the cost of equity capital. But the risk involved in borrowing, however, is greater than internal funds. Thus, firms do not generally raise funds from only by borrowing, but also by selling stocks. This creates certain capital structure of equity and debt. Certain proportion of the composition is used to achieve maximum return possible with the distributed risk between debt and equity. To estimate cost of capital from the capital structure, weighted cost of capital is used as the equation on the screen. The proportion of debt multiplied by the cost debt plus the proportion of equity multiplied by the cost of equity. I think that's it for my presentation. Thank you for watching. See you on my next slide. Bye.